All right, let's be honest. I'm a bull, but seeing this market crash makes me want to adapt to this market by selling my positions and buying some put options. I saw Teladoc was down 50% after Cathie Wood bought it. Shopify is about 70% down from where Cathie Wood bought it at $1,200 per share. Everything Cathie Wood buys has actually fallen. This week for earnings, I was thinking to just buy puts on literally everything. Looks like nothing is safe in this market. And I'm going to be talking about stocks that I think could fall further, so buying put options on the stocks I'm going to discuss, and other strategies is going to be wise in this market environment. UPSC after earnings fell 48%, and I was thinking to myself, man, if I bought even $10,000 worth of puts, it would be $100,000 in one day. In the technology space, I don't see that many safe havens. What I'm going to do in this video is go over some specific plays I'm bearish on and that look like you can make asymmetric returns on the downside. What I mean by that is finding stocks like Shopify that are falling and betting that they are going to fall further. This way I can invest some money in buying puts and even sell some call credit spreads, which I'm also going to discuss in this video. I've already started doing that, so I'm going to show you all my positions and go over them, and then I'm going to tell you about other plays. All right, so as you see here, Cathie Wood's fame market beating return is disappearing and it's absolutely gone. So if you look at her performance right here, sure, she did really well. Most of that was due to holding some really risky stocks. However, once things started to hit the fan, you can see right here that she has tremendously underperformed in the recent basically year, and now her performance is right down with S&P 500. It just goes you, no genius, no person out there, no billionaire is going to actually outperform the market in the long term. We're all subject to gravity, and basically gravity in the market is the S&P 500. It's not just Cathie Wood or Bill Ackman losing $400 million on Netflix, but the S&P 500 itself is down 4.73% over the past 1 year. Now, my Robinhood portfolio over the past year is up actually 16.7%, so I've beaten the market by 20%, and I've beaten Cathie Wood by over 70%. I'm not saying I'm always right, but I am pretty decent at option trading, and these are my current positions. So I am actually hedging my portfolio by selling call credit spreads. So I sold some call credit spreads on Apple, on Amazon. I am selling a put option on Amazon, which is a really big position. This is not typically what I do in my private Discord. Typically, I'm making smaller account trades, but I had a lot of capital available to me and I wanted to sell a put option on Amazon. Anyways, if you look at Disney, I have sold a call credit spread, Facebook call credit spread. So basically, I'm selling a lot of call credit spreads. I'm going to show you another one that I am going to open up when the market opens. Now, I've made money on Rivian. I'm pretty flat on Shopify, and I have sold some put options on Facebook. On Nets, I'm up 100%. If you look at my other positions, basically, I'm doing a couple things right now. I am selling a whole lot of call credit spreads, and I'm also selling covered calls on my positions because I don't really want to hold that much stock right now because the market is falling down. I want to make sure I'm hedging as much as possible, and that includes selling call credit spreads, which I'm going to show you an example on in just a second after I cover Upstart, Adobe, and Shopify. I'm going to pick these three stocks. I'm going to pick one of them to do a call credit spread on. But basically, I do not really want to have open positions that is just stock because as the market falls, I'm going to suffer losses. And the least I can do is sell covered calls for some premium and call credit spreads, because call credit spreads that are out of the money are going to bring in some premium for my portfolio, and they're going to be a hedge if the market continues to fall. Now, let's look at Upstart. Okay, Upstart just reported earnings and this stock went from $77 down to $31. So again, I wish I bought some put options, like I wish I bought some put options on Netflix, but again, I'm not a genie. I couldn't predict the market. But gosh, in the private Discord, I have mentioned UPST is super dangerous, and now we see that this stock is going to open up and it's going to be down tremendously. Now, I do think this stock can actually fall further, but currently I'm not sure. When the market opens up within that first 30 minutes, I want to see what that price momentum is going to be like. Now, the next stock that I do want to talk about though is Adobe. Adobe I am much more clear on because Adobe is an amazing stock in many ways. However, the valuation does not make sense, and also the trajectory of this stock makes perfect sense in terms of it's going down. It's clearly going down. It's a very bearish trend. All the indicators to me are signaling that this stock is going to continue to be bearish. Now, I am a fan of Adobe. I use their services. I am on their subscription myself. But when I go to statistics, right, this stock is really trading like a full-blown technology company, almost like a Tesla. I mean, the price to sales ratio is 11.6. That is ridiculous. I mean, if I go back and I analyze Tesla's price to sales ratio is probably not that far from 11. Now, anything over 10 is a a very expensive company, and it's typically a technology stock. Now for Tesla, you see here it's 15.8. I love Tesla, but the thing is, we all know that Tesla is not really a cheap stock by any stretch in terms of its valuation. Now Adobe, considering that Adobe is not growing like Tesla, I mean, look at the quarterly revenue growth, it's 9%. Whereas for Tesla, the quarterly revenue growth is a lot higher at 80%. So tell me, Tesla is growing basically almost 10 times faster than Adobe, yet Adobe's price to sales ratio is 11. Now I love Adobe, so I've been not looking at this stock in terms of a short or in terms of buying put options or selling call credit spreads, but really this valuation does not make sense. I think it's a fantastic company, but the stock price absolutely overvalued in my opinion. Looking at the price to earnings forward is 28. Now it's only growing similar to the S&P 500. On a forward ratio, the S&P 500 is around 17, okay? So we're going to be looking at an Adobe call credit spread, but I also want to look at Shopify, okay? Shopify is really important. I also want to take a look at the price to sales ratio. Now Shopify is a high growth company, okay? It's been growing like gangbusters. It's recently sold off because the e-commerce trend is slowing down a little bit because after the pandemic, people are going into retail stores again. They're still shopping online, but that trend did decrease just a little bit. But the price to sales for Shopify, which is an e-commerce brand growing super fast, is 10.43. So again, Adobe should not be that expensive. So I think again, Adobe is going to be the best play right here. So I'm going to show you what I'm going to do with Adobe in my portfolio. Now I don't currently have an Adobe position. The reason for that was previously I was actually trying to sell some put credit spreads because again, I'm really bullish on the business. It's at 1.77% pre-market. I think the general market is going to be up today. But anyways, let's go to trade Adobe options. Now I'm going to be looking at an expiration date that is probably going to hedge my portfolio for the next month or maybe, 5 to 6 weeks. So I'm going to go out to June 17, which is 5 weeks out. And now I'm going to look at a sell call, okay? I'm going to click sell call because I want to sell premium here. I want to bet that this stock is not going to rise a lot. I'm scrolling up here because I want to make sure that I sell an out of the money call option. So I'm going to look at the 430 and basically I'm looking at the 430 because I like a chance of profit of over 80%. So 84% looks good, 85% looks good, but let's expand the 430 option right now. The bid is $7, the ask is $7.75. Pretty good. The implied volatility is 49%. That's also pretty good. Anything over 40 is really decent. And the volume is actually really good for something that is super expensive. So Adobe is an expensive stock, $383. So if someone had 100 shares and they were selling call options, they would need $38,000. So obviously I'm going to show you a call credit spread, which is going to be a lot cheaper. I mean, it's going to be probably less than $500. In fact, I'm sure it's going to be less than $500. Okay, the delta is 0.22, which means this is an out of the money option. And there's only a 22% chance that Adobe is going to go higher than $430 per share. So what I'm going to do is I'm going to sell this call option right here. I do like it. There's a premium of $738. And now I'm going to click buy call option. The reason I want to buy a call option is if I sell a call option, now I have unlimited risk, right? The stock can go up and I'm in trouble. And I also can't sell naked call options because it's super risky and most brokers will not let you do it. So instead I'm going to buy a call option. I'm going to protect this $430 call option that I'm selling by buying a 435. And I can already tell that the difference with $738 of premium is how much I collect. Now I have to pay $633, but I'm actually left with $105 left over, okay? And I'm only risking $395. So there's two things that is going on right here. Not only am I collecting $105 worth of premium coming in, I'm actually also having a hedge in my portfolio. So basically, I do not expect Adobe to go up, and I'm hedging my portfolio by selling delta, okay? This is a net sell position because the delta is 0.22 that I'm selling. Now I am buying a 0.2 delta, okay? So I'm net short. I'm net short about 0.02 delta. Now that is not a lot. However, I am reducing the overall risk in my portfolio because if the market continues to crash, no matter what, really, Adobe is going to go down with the market. Now, in general, because I also think Adobe is overpriced, even if the market goes sideways or a little bit up, I think Adobe is going to underperform. So now I have two reasons to sell a call credit spread. One is to hedge my portfolio because if the market goes down, this position position is going to do well. And two, I am selling a call credit spread on Adobe because I think Adobe is overpriced. So now two reasons to sell this call credit spread. Collect $105. Yes, I'm risking $395. However, this is a very high probability trade that is going to end up in my favor. And the percentage return here of $100 by basically risking $400 is going to be a 25% return in 5 weeks, 5% a week, fantastic return. This is a play that I'm looking to open up in my Discord community, and I wanted to share it with you guys on YouTube.